I'm sure you're just like me, and after seeing the interest rates in 2020, 21, and 22, when the interest rates were 2, 3, and 4%, you guys now look back on and kind of see the full perspective of how an interest rate can impact the daily consumer. Realistically, most people didn't know. A lot of people are just happy that they can actually get qualified for a loan by going through the steps of qualification and say, hey, great, we got a house. But now after looking at it, where our average rates right now are at 7.5, there are two different scales that have to be known. So today in this video, I'm gonna break down how interest rates hinder, harm, or help the consumer when it comes to the housing market. What's up, guys? It's your boy Sawan Belcher. This is me taking action on Instagram and YouTube. Here we actually talk about real estate investing and how you can make as much money as possible during a 30-day period of time while you cherry pick the very best houses for yourself. Now today I want to actually help you guys understand more about mortgages, how it's calculated, how it helps and how it hinders, so that way you guys can make a more informed decision when you're going out and building up a portfolio for yourself and for your family as you're teaching your kids. Okay, so now number one, what is interest? Okay, interest is simply the amount, how much money you pay for the money that someone else gives you. Now the biggest part or the biggest blessing or the thing that I love the most about real estate investing is in order for us to buy it, we don't have to have cash. A lot of the times we're buying stocks or other investments, we have to use our own cash so that way we can get in the deal so we can create this kind of wealth. But with real estate, it can be leveraged because it's a real asset and can be backed up by insurance. Realistically, lenders think this is safe for them to invest in because if it burns down, you still have land and the insurance pays them off. Now you have a free and clear property and you can still build on. Okay, does that make sense? So it leaves you and them at a super, extreme protection. Now, interest is determined by a couple different things. Number one, your credit worthiness, how good or bad your credit is and how well built out your credit has been built over time. And then also the value at which you're buying at. So let's call it loan to value. So if you get a property that's appraised at 200 grand and you're buying it at 220 grand, of course you might see a point or two or some penalties. So that way they can recoup their money faster. Okay. Also on the opposite end, if you're buying at a 200 grand house for 150,000, you might see a lower interest rate with lower origination fees and those things because you're in a safer position. And then lastly, how does this all affect you? Well, think about it. If you have really bad credit, okay, you're not going to get favorable interest rates because once again, the more interest you pay, the more the mortgage company gets paid. The more interest you pay, the sooner the banks will get paid. Now, the way a mortgage works is even though it takes 30 years to pay it off, this is an amortized schedule, interest schedule, meaning at the beginning of the loan, you pay the most interest, and the further you get down the loan, you pay less interest. So typically within the first 5 years, you haven't paid a lot in principal, how much you actually owe down, you've paid more in interest. So typically when you see a lowering of interest rates in the banks, somebody is trying to help influence how many people are buying right now in the market. Lower interest rates means more buyers apply, more people are willing to get this cheaper money, and of course that makes prices go up. Now, when interest rates go higher, less people don't want to buy because they don't want to pay that much for the money, especially right now we're at 7.5%, 8%, okay, for money. You get less buyers in the market and it tends to slow prices down or even bring them down. Remember, whenever you see interest rates go down, you should be buying with traditional money and refinancing with traditional money. Whenever you see interest rates go up, you should be focused on getting creative, going off market, using tactics like seller financing and subject to in order to get the best methods. Now, in order to learn more about real estate investing and how you can maximize your current portfolio for rental property, Airbnbs, group homes, flip properties, and whatever, and even your personal property, follow us right here on YouTube. Peace, y'all.